Hello and welcome to Business Morning. I am Bisi Adebayo. Well, let's kick off the program today with Ecobank Nigeria, which is a member of the Pan-African Banking Group, which hosted its first regional trade forum with the theme Facilitating Regional Trade in the Emerging AfCFTA Era. Well, the forum was a platform to explore trade opportunities in Africa, particularly after the COVID-19 pandemic. Let's see the report.
The first virtual regional trade forum by Ecobank Nigeria to examine the opportunities provided by the pandemic for Africa to take its place in global trade. The forum, with the theme Facilitating Regional Trade in Emerging AfCFTA Era, had exporters and importers within the African region exhibiting their products and participating in panel discussions by highly experienced and diversified stakeholders in the industry.
Our population is projected to reach 2.5 billion by 2050. There is the opportunity to gradually eliminate tariffs that are impeding intra-African trade and to boost intra-Africa trade significantly going forward.
While political will is required to support initiatives to develop infrastructure and facilitate trade, the African Continental Free Trade Area Agreement creates more opportunities for regional trade.
There is an opportunity there on many of the products that we're seeking from outside the continent to source those within the continent. And for ECOWAS, that has a number of industrial powerhouses, we expect them to take opportunity of their production capacity.
I cannot ask Volkswagen to come and set up a manufacturing of cars in Togo just to serve Togo market. But they can set it up in Togo to serve West African market. They can set it up in Lagos to serve West African market. So that an investment opportunity is not just looking at individual fragmented countries, is looking at the whole continent.
Meanwhile, the Nigerian Export Promotion Council has decided to step in to help boost export capacity as the country gets set to ratify the agreement.
When you come into a trade agreement and you really have to regulate your borders and how goods move, then you must get all these certifications. And we can only do this by doing trainings for our exporters, for our farmers, for our producers, for our manufacturers, and get them to get those certifications.
Ecobank Nigeria, with its unrivaled footprint across Africa, is using its platform to facilitate cross-border trade within the region, leveraging its comprehensive trade solutions and various payment methods available across its network within the continent.
And here's another one coming from investors of frontline global cement maker Dangote, who may now look forward to a silver lining in investment returns despite the negative impact of the COVID-19 pandemic on its business. Top executives of the Nigerian and London Stock Exchanges listed company gave this indication at the virtual presentation of its sustainability report and market briefing before the management of the Nigerian Stock Exchange.
In the last few years, transparency on environmental, social and corporate governance issues have become a major part of public company structures.
Today's event.
This trend informs the virtual and second edition of Dangote Cement's Sustainability Report presentation. Apart from its commitment to a world-class sustainable business, Dangote Cement successfully complies with other environmental, social and corporate governance performance within the 2019 calendar year.
Our 2019 socio-economic impact study shows that our patronage of local vendors generated 21,237 jobs and 66 billion naira in household income across our supply chain.
Following the supply chain disruptions emanating from the impacts of COVID-19, Dangote Cement has become more prudent with its resources.
One significant impact that we have seen is a lot of the energy costs that we utilize are or through importations in foreign currencies, and the pricing is usually pegged to US dollar, or direct pegging of the local supply that we get. For example, gas in Nigeria is pegged to US dollar. So evidently, when the currency is eroding against these foreign currencies, we have a negative impact on our bottom line.
We are acting like a responsible citizen in developing these technologies, aiming at cleaning countries, cleaning Nigeria, cleaning Africa. This is really what is at stake behind your questions.
While currency pressures remain the major constraint of multinationals in Africa, Dangote Cement has already hedged with its debt structure.
You can see from the capital and debt structure that they front-loaded their debt profile at the early stages when interest rates are low, and will take advantage of this in the future.
As Nigeria braces for the ratification of the Africa Continental Free Trade Area Agreement, Dangote, Africa's leader in cement and clinker export, is confident of broad range of returns via export earnings.
Now, in recent times, the Central Bank of Nigeria has been reeling out measures to contain foreign exchange abuse and control outflows from its reserves. The latest and the most explicit of such measures is contained in a circular making the rounds, which places a ban on customers-to-customer transactions and explains the use of foreign exchange proceeds from the various channels of FX inflows. Analysts have, however, been questioning the effectiveness of these control measures as exchange rate has remained stubbornly high despite the resumption of sales to bureau de change and interventions at the investors and exporters window. Well, joining us now to examine this concern is the Managing Director and the Chief Executive of Flame Academy and Consulting, Mr. Oji Udemezwe, who joins us from our studio in Abuja. Good morning, Mr. Udemezwe. Thanks for joining us on the program. Now, in late August, when buying agents and companies and third parties were removed from accessing the SME's forex window through the Form M forex purchases, did you expect any difference in the exchange rate?
Well, let me just say with due respect to the central bank that they are overburdened, in their task to apply monetary policy levers to support the economy. But it still remains a fact that the Central Bank of Nigeria has got to a point of monetary policy exhaustion. They are trying to use monetary policy to solve Nigeria's problem both on short-term and long-term basis, and it will never be effective. At the risk of sounding uncharitable to the central bank, the policy reversals and somersaults we are seeing are just inevitable. They will continue to make all kinds of announcements, all kinds of threats to FX suppliers, in the bid to improve liquidity of FX supply, because we are facing a huge supply side problem. But all those announcements that I'm making, including the one you just mentioned now, and all the restrictions in customer-to-customer transactions, and all the other measures they are trying to use to curtail abuse of the FX will never work. Both from a moral point of view and from even a technical point of view, the central bank can never solve this problem the way they're going. If you remember, earlier in the year, the official rate for Naira-dollar exchange was 307, and around March, it moved. They had to bring it close to the I&E window price to 360. And just recently again, we saw that move to 380. Some 2, 3, 4 years ago, we had made this point repeatedly, that the central bank had to be bold to close the gap between the several rates available in the market. You have the official rate, you have the I&E window rate, you have the some dealers rate, banks rate, you have the black market rate, you have all kinds of rate, transfer rate, and so on. And all that speaks to the fact that Nigeria is a nation in trouble, that our balance of payment is we have a total imbalance in trade. No matter how you want to put it, anytime you have a situation where you bring in little effects in terms of your exports, particularly when we have a mono-product economy where our export is purely or 95% oil and gas products, you find that what we get is no more enough to meet the demand for FX. And in this supply-demand dynamics, there's no way you can stop people from demanding or asking for something they find utility for. So even if you cut off all the avenues, shut people off from getting FX through the dealers or other platform you provided, that demand must find its way somewhere else. So the issue we have in this country is supply side challenge. The demand remains strong as long as we don't produce what we eat, as long as we import most of the things that we consume in this country. And you find that because we need these things and we have to find them one way or the other, people must make this demand. Then do we have enough supply of FX to enable people to get these things from anywhere in the world they want to get them? So that's the challenge. And how do we solve this? If we have enough time in this program, I will still profile my solution. I've mentioned this over time. When Egypt was faced with the same problem with Nigeria, they took a drastic measure, which we refuse to take. And those who always feel that they love this country more than some of us who have been talking about central bank facing the reality of finding an appropriate pricing for our currency, they keep saying, oh, we cannot liberalize the market, we cannot allow it float, even in a managed form. And over the years, you see us getting worse and worse by the month, by the years. Some 2 years ago, we were somewhere at 200 and something, and even the futures market said that our right pricing would be 225 at some point when we are doing 160 or 180. We didn't agree with them, and they said if we had done that and merged all the rates, we will bring about a more efficient supply of FX. There's a big liquidity right now. Our external reserve is depleting, going down every other day because the supply of FX is much, much, much lower than the demand. And so all these rules they are ruling out, you must bring in, exporters must bring in their FX to the central bank. They cannot sell to other people who need them. They will never work, without sounding immodest or uncharitable. Because the point is that even in that policy where exporters are forced to report their FX central bank, who will do that? When you know that central bank itself are constantly selling this FX, on a platform where people buy them and round trip them. It's morally wrong. Anytime you have multiple rates of FX, you encourage bad behavior, you encourage misappropriation of these funds, you encourage inefficient allocation of resources, and you encourage, criminal activities. People get this FX at some rate, some funny rate, maybe 380 today, and the next second they sell at 460, 470. Why wouldn't they continue to do that? And then, as an exporter, I suffer, I go to the farm, I struggle and do all kinds of things. I'm bringing my FX, I submit it to you, central bank, at 360 or 380. Meanwhile, when I buy things in the market, I buy at the rate of 470, 480. I won't do that. What ends up happening is that the little FX providers, small exporters are forced to report these things grudgingly. And the big players, I don't want to call them here, the big players continue to send their FX to anywhere in the world they want without reporting to central bank.
But Mr. Aldemezwe, yes.
Issued by central bank, nothing is done.
All right, Mr. Aldemezwe, beside the limit to US dollar card transactions and, of course, FCI bank transfers, the latest restriction is that of customer-to-customer transactions. What do you consider as the significance of that directive?
Excuse me, I didn't get that, please.
I was talking about the customer-to-customer transactions, which is the latest now. So what do you consider as the significance of that directive? That's if you've read the report and other details that emanate from it.
Okay, when you try to curtail customer-to-customer transactions, central bank is just trying to limit, how people use the FX, in their position. Sometime earlier, if you read the news, you also noticed that central bank, placed the accounts of some dealers, on suspension, what they call post-no debit. They can bring in FX, but they wouldn't, spend them because there was fear that they could sell them to the market on their own and maybe deny central bank of control of those FX distribution and all of that. So the customer-to-customer thing is still part of the desperate effort to limit people, doing panic buying, people doing speculative purchase of FX, possibly to save it for a later day when it might hit 600, as speculators will always tell you, and all of that. So they're trying to see how they can curtail, customers. But in a real market, that's actually what should be done. People should be able to get FX, from any source they could find. And that way, suppliers are free to bring in their money, knowing that they will sell it at a normal, at a unified market rate. And when you make this thing available, Mr. A, Mr. B can sell whatever FX they get in. This speculation will end. So with all these rules central bank is placing, they're trying to fuel speculation more and more. These are desperate measures, and the market always reads them, that central bank has lost it. And by issuing out these directives, they're sending more and more uncertainty, more and more fear in the market that they are unable to, manage the flow of FX in the market. So, restricting customer transaction, restricting, how exporters use their FX inflows and all of that are all recipe to, continued FX scarcity. It will never help us. So the only way is that if central bank can find a way and, face the consequences like Egypt did, to unify the rates, let the rate at which government buys FX be very close, if not exactly the same, to the rate at which businesses buy them. The I&E window, if it reflects the real rate for us, let that rate not be far away from the black market rate. But once it is not the same and the gap is much, people will always come to I&E window, find any way to document their transaction, get the cheap fund, and come and round trip it in the black market. It's only when you unify or at least reduce the gap between these rates that you can find a free flow of FX, both at the supply end and and demand end. And once the flow becomes very free, speculations will be eliminated. And then person-to-person sales can happen without any consequences. And exporters can bring in their money knowing that the rate is the same everywhere. So whether they give it to central bank or they sell it by themselves, it won't make any difference. Nigeria has a big challenge that we have refused to face. We are still applying the ostrich mentality of hiding our face in the ground when the real issue is facing us. Can we be bold enough to do like Egypt did? And today, Egypt represents the highest FDI inflow into Africa because they were bold enough to unify their rates. Yes, it spiked their inflation rate. It spiked, a lot of trouble in the economy. Prices went so high. But over time, because Egypt, maintained the pound at, a single rate, there was no more uncertainty. All the foreign direct investors, foreign portfolio investors, no longer had any concerns bringing their fund into Egypt. And before you knew it, Egypt became Africa's foremost, destination for foreign direct investment and even foreign portfolio investment. That was about 3-4 years ago. Nigeria refused to do that, and we kept holding it down because we seem to have a large external pool of reserves at that point. Today, that reserve has moved from $45 billion to nearly $34 billion. And it keeps getting worse, in this regime of COVID, where oil price has hit, some low and is not very eager to move up again until we find solution to COVID and until all the players in OPEC plus, if that still exists, are able to resolve the supply cut measures. Pending when that happens, oil price remains at the region of $42 to $47 per barrel, which is not quite profitable for Nigeria. And unfortunately, even when we make the money in oil, crude oil sale, Nigeria still goes back to lose all of that when we import petroleum products. Even though subsidy has been somewhat removed, it still costs us a lot to import this product when we can produce it locally, create employment, and curtail our FX demand. And I made a comment earlier that central bank is trying to use monetary policy levers to solve this problem. But what you find at the end of the day is that the only solution to Nigeria's problem, if I must give that a shot at this point, in the medium to long term, Nigeria must cut off every item that we import foolishly, that we ought not to import to start with. If you can remove petroleum product importation from our a basket of imported goods, if we remove that, we can cut our FX demand by almost 30% or 40%. If we're able to ensure that our refineries in Port Harcourt, Kaduna, Dangote refinery, and other modular refineries that we can encourage, let's bring in the private sector and supply them with this crude oil. They refine for us. They can have a deal with NNPC, and we cut off this FX demand. Can we also pay attention to agriculture? Make sure that from Taraba to Katsina to Ebonyi State to Enugu to everywhere that we can produce rice, that local rice becomes prevalent in all our markets, and that FX we spend foolishly in importing rice can be cut away, and several other things that we import that we don't need to import because we have arable land here, we have solid minerals that we don't process. We begin to look at post-harvest technology in the agricultural value chain, such that every agri-product that we produce raw from the farm, we can also process them. How can you have all the pyramids of groundnut and other grains in this country?
I do apologize. I would have to cut you at this point, Mr. Demezwe. Please just hold on to your thoughts. We'll continue this conversation in just a moment. Welcome back. We still have the Managing Director and Chief Executive of Flame Academy and Consultant, Mr. Oji Udemezwe, talking about the latest developments in the foreign exchange markets. Thank you, Mr. Udemezwe, for sticking around. Now, recently, the accounts of some 38 firms were frozen on account of forex infractions. How many of such sanctions do you expect in the financial system?
We will get tired of saying some of these things over time, but it is well. We will get there. By freezing accounts of companies who perhaps receive inflows of FX and sometimes decide to sell it by themselves to be able to match the market rate, what you're going to be doing is to scare people away all the more. And then the problem continues without end. You could sanction them, but you cannot solve the economic problem. These companies, buy inputs, they pay salaries, and they do all kinds of things at the current rate of, prices in the market. Then when they bring in their FX, you insist that they will subsidize it to the government by selling to you at some crazily low rates. Yes, because you're the regulator, you could hit them on the head. But at the end of the day, you create, jitters, you create fear in the market.
But Mr. Udemezwe, these companies are said to
like
have committed infractions. Shouldn't they actually be sanctioned for the offenses?
Well, as long as you have a rule that they have disobeyed, you can call it infraction. But I'm saying those rules, are we supposed to have those rules there? So if they have disobeyed the sanction, yes, please, by all means, sanction them. I'm not saying they shouldn't be sanctioned. And such sanctions may continue. But you find that as you pursue these people, let me give you an analogy. You know that rats love fish, all right? And then you have some fish you want to protect. You leave that fish in the open, in a cage, where rats will clearly go and attack that fish. And you now warn all the rats in Nigeria to say, no rat should come near this fish. If you do, I will sanction you. Now, no matter how much sanction you announce, any rat that is what's called a rat must come near that fish and maybe run a risk of being sanctioned. Why don't you remove the fish? Why don't you remove the big gap between all kinds of rates we have in the market? That's the only way you can find an end. Otherwise, rats will always hang around where you have fish. You can never do away with that. Let us look at more solid, short-term to long-term solution to this problem. So we'll stop running around the circle in the country. Why don't we look at ways to boost FX inflow through our monetary policies and fiscal policies, to boost export by all levels, to support SMEs, to create a very good business environment for SMEs to thrive, to do deliberate, like they were talking about a few minutes ago on your program, in the African Free Trade Continental Agreement. That's a way to boost inter-Africa trade, whereby our demand for FX, because if we have a common African currency, the ECOWAS currency and all of that, our demand for US dollar will drop significantly. And we can trade within ourselves. So many things we cross Africa to go and buy in China and other places, we can do it within ourselves. And even the FX, so many things that we also have rotting away in Nigeria because we cannot meet Europe standard and American standard of export. We can send them to Uganda. We can send to Kenya. We can send to South Africa and other places, and we can intertrade and improve our self-sufficiency and drop our huge demand for FX. So let's look at those directions. Let our fiscal policy in Nigeria, encourage states to become very entrepreneurial in driving revenue. Let's not keep gathering in Abuja every month to share handouts, and we remove incentive for governors of states to drive their states as business enterprises, where every form of resource in this country, vegetables, grains, animal husbandry, and all kinds of things are brought to the market, particularly the export market, so we can diversify our export earnings and stop this carrot and stick approach to FX management. Enough is enough. Let fiscal policies in this country ramp up enough to join central bank. Let me also say that central bank has been doing their best. I'm not in any way trying to rebuke them excessively. They are doing their best. Governor Emefiele is trying his best. But all I'm saying is that his best will never solve our problem, because there are several issues that must be taken into consideration to complement the effort of the central bank. They have even gone away from monetary policy to pursue fiscal policy incentives by doing anchor borrowing programs and all kinds of things to provide easy access to funds, to businesses. The fiscal policy levers must be drawn to government grants and government vote of funds to support business environmental development, infrastructure development, to enable SMEs to work better and improve our export. This is very important in the medium to long term. Otherwise, this carrot and stick approach, knocking people on the head, sanctions everywhere, will continue unabated, will continue endlessly. So the central bank is doing their best. Let the fiscal policy people, also let the Ministry of Finance and the FEC, Federal Executive Council, also meet them with policies that will encourage long-term improvement of FX supply. If people are bringing money through international money transfers, they cannot do that anymore, because if somebody is sending money to the family by way of, what do you call them again, all these money transfer systems, you don't expect the person in America to send money and the mother or the brother will go and exchange it at 380 when they know that the real market price is 470. So that way you shut down the international money transfer sources of FX. Foreign investors cannot come in because already Nigeria is a nation in war, insecurity, problems everywhere, instability in policies and so on. So you don't have foreign direct investment. And to worsen the situation, foreign portfolio investors cannot also come in because our rates are quite low for them now. And the effective rate in the economy today is negative. Inflation is at about 13.22% today, while the MPR was just reduced 2 days ago to 11.5. I'm not saying they should not reduce MPR. Central bank is actually confused as it is because one policy they are trying to execute counters other policies. The rate reduction 2 days ago is good for the economy to thrive in that there will be lower interest rates for businesses to borrow. That's the CBN justification. But then, as you do that, be mindful of the fact that our inflation rate is now 13.22, while the MPR, the benchmark interest rate, is 11.55, meaning that in this country today, the view of the world is that Nigeria has a negative interest rate. So portfolio investors who are looking for effective yield in their investment will never inflow their funds. So we are trapped in a situation whereby only central bank will keep supplying FX by depleting our external reserve, and other sources of FX supply will remain, standby till further notice. That's
now,
when
you look at the current exchange rate of the dollar at 460 to 465 to a dollar now, how sustainable do you think that is?
Well, that rate is not sustainable. To be fair to this country, Naira ought not to be selling at 460 or 465 to $1. We could do better. But when the supply is not certain and the rules are so tight that you cannot get this dollar easily, you tighten all the other sources of you remember that people that are going to be taking the hit on this are smaller dealers, smaller importers, smaller exporters, importers who have been shut out from the official market. Remember those 41 items and more added today who are told you cannot get FX from central bank because what you are importing, we don't need to import them. Or we want to apportion that FX to other sectors that need that money more than you. So are you saying that you close down? You have not declared their businesses illegal. You have not banned them from operating. You've only excluded them from official window to get FX. They will get it elsewhere. And the more desperate they get in trying to sustain their businesses by getting FX to bring in input materials and other imports that they do, the more desperate they get, the more they are willing to pay for a dollar with local currency. But when you do a bit more liberalization, close the gaps down, it will hurt us temporarily for a while. But if you now say that official rate will now become, let's say, 420 naira to $1. But in doing that, you allow freedom. If you export, sell to whoever you want, and all the exporters, in fact, you are going to drive export. Because what we're doing currently is that we are inadvertently closing down export, which we need most, at this point in this country. So when exporters have to fight, do all the measures, package their product very well, suffer a lot to bring in FX, and you tell them you must sell it at a government rate of 380. You discourage exports, which will worsen our situation in medium to long term. So why don't we bring a rate that will be uniform, even though it will appear, because we've been saying we don't want to devalue, but then we have been having depreciation of this currency. And as it depreciates more, government is forced to devalue because they are not at the same time. Depreciation means that by forces of demand and supply, your currency gets weaker against foreign currency. Devaluing is to deliberately bring the price to where you think we unify these things and make it. So as we keep saying we will not devalue, we are being forced to devalue over time. Like we did this year, 307 to 360, now 380. Why don't you do it deliberately and as a way to harness export and remove all the fears, all the sanctions and all of that, and encourage free flow of FX amongst customers, from exporters to other people who want to import. Make it free. The central bank will focus on other key monetary policy issues. And as you make it free, you're going to remove every uncertainty in the market and encourage foreign FX inflow, both through direct investments and portfolio investments. You can see that every other supply source has been shut down until they see a uniform rate that's reasonably stable, even if it's not a single rate. Let it be closed. You mustn't have more than 5 naira or 10 naira gap between one rate and the other. But once the gap is too much and too profitable, round tripping and bad behavior or corrupt practices is encouraged.
All right, Mr. Odemezwe, we need to round up in a couple of minutes, but I'll just like to ask you before I let you go, is there any possibility that the rates in Nigeria will return to the pre-COVID-19 days? You have 1 minute to answer that question.
COVID has brought new dimensions to businesses. We may never return to that point. But in fact, we can actually return to that point even well before COVID. But that's only when we fix these issues I've mentioned, these medium to long-term measures. We can return to pre-COVID price, but it will take long years of good practice, long years of improving export, long years of ensuring that people are free to trade in this product, long years of encouraging foreign direct investment and portfolio investment and even local investment, so that we can begin to depend on ourselves for many items. With long years of self-sufficiency, we can actually bring this currency down to 200, 300. It's possible. Long years of trying to fight to stop importing petroleum products, to stop importing rice and other things that we can produce locally. Long years of devoting our monetary and fiscal policies towards economic self-sufficiency in Nigeria. Thank you.
CEO of Flame Academy and consultant, Mr. Oji Udemezwe, thank you for sharing your time with us on the program this morning.
For inviting me.
Now, let's get a review of yesterday's activities at the NSC, and Temple Ashaji will be doing that for us. Good morning, Temple. Over to you.
Good morning, BC. Well, if there's no interest in FX space, equity actually has some interest for investors who are wondering where you have some opportunity at this point in time. Because consider the fact that yesterday we had an auction, and of course the day before we also had an auction, bond auction. Of course, the bond auction, we saw a reduction of some 12 basis points in the rates. That's not so interesting or impressive for a lot of the dealers that participated at that auction. The DMO even ended up not actually offering or selling all of what they actually offer to investors. So folks are beginning to come back to the equity space, and that's what is fueling the whole of the interest that we're seeing in recent times. If you check in the last 3 months in this market, in the capital market financial space at large, we've been seeing a whopping interest, whopping transactions, volume of transaction in the market, in the equity space. And this has continued in spite of the fact that some of the tier 1 banks that actually offered to pay some dividends to investors have actually are beginning to do that. Some of them have been paying the dividends given the qualification date and of course the payment dates that we're beginning to see. And of course they're scheduled for the later part of the month. So yesterday generally we saw 106 billion naira contribution to the equity capitalization. Now it's hovering. It looks like something that will actually touch the 14 trillion naira mark if the whole momentum that we're seeing in recent time continues without, that's barring any form of unimpressive news that may hit the market or hit the economy at large. Because again, you know that recently the CBN reduced the MPR, lowered it by 100 basis points from 12.5% to 11.5%. So folks have returned to the stock market, beginning to pick the low valuations that we have there. And that's why we saw a whole lot of bargain hunting in the market yesterday. But if you look at the volume of transaction, this would have been green, but it was red yesterday. It tells you that a whole lot of activity in the space. It was down by 13%. And of course, the value of transaction was down by 38%. Now we have crossed the 3 billion naira that we regularly do on the average and daily basis, and it looks like eventually we will be doing some 4 billion naira in the market. Look at the volume of transaction, which is down by 13%, and we had just 359 million units of shares done. 72 million units of Sterling Bank shares were actually traded for 83 million naira yesterday, and that was the most actively traded stock in the market. Let's look at the sectoral performance. Told you, banking stocks positive 1.59% in the market, and of course these are the major picks for every smart investors that you have in the market. EcoBank was up by more than 2%, 2.5% specifically. Access Bank, 3.97%. Zenith Bank, 0.59%. GT Bank, some 1.96%. And of course, your wonderful FBN Holdings was up 1% again yesterday. Haven't seen some bargain or sell or rather profit taking a few days ago, and it dropped lower than 5 naira, but it's way back up now, more than 5 naira in the market. All of these counters that you have under the banking stocks yesterday were positive. Consumer goods side of the market, positive as well. Nigerian breweries, which led 25 other companies yesterday, was up 10%. Flour mills was up by more than 6%. You also have a lot of the stocks that you have here were positive yesterday. Industrial goods side of the market, Dangote woke up, was up by 89 basis points after, of course, we had some top executives of the company saying that, look, we know what we are doing. We've actually structured our debts very, very well. We've hedged ahead, and telling you that they have actually been paying dividends all along, and this is something that they hope to sustain in spite of the COVID-19 impacts, which has been hitting the energy costs and, of course, through the whole FX challenges. WAPCO was also positive yesterday. Insurance space, we saw profit taking. Oil and gas, we saw profit taking in spite of the fact that we got some gains. Adova was up by more than 1% yesterday. Adova was actually down the most yesterday, led 6 other stocks to go downwards, and of course 11 PLC was up 1%. Then you have a bigger bargain hunting, 45 basis points on O&O yesterday, and some sell down after Etana PLC touched more than 2 naira 50 something kobo in the market. We have Jamil Mohammed joining us now. He is the stockbroker with APT Securities and Fund. Jamil, I know you know why we actually we saw the bullish sentiment we had in the markets yesterday. Tell us why, and of course, how sustainable is that?
Okay, thank you very much, Tempo. As I showed you, it's a pleasure being here on the program. What actually happened in the market is just because of the release, the adjustment in the MPR rate by the MPC meeting, which was held Monday and Tuesday this week. And you can see that this bullish run has been there since the beginning of the week. And what this implication means is that whenever the government is lowering the MPR rate, what it means is that they are reducing the national propensity to save. So people tend to lose their savings, move their money from saving to investment. So in a situation whereby you have lower interest rate in money market, what people go to is the capital market. As it is now, you can see now as we have the inflation at around 13%, 13.22%. If you continue to save your money at the rate available in the money market, you are losing. It's only the capital market that can be able to give you that return. So that is why you see people moving from the money market. They are now rushing to capital market where they can be able to get inflation adjusted rate of return. That is why you see that bullish run in the market recently.
So, Jamie, we know that the impetus that we got now actually came from the monetary authorities. What kind of supporting policies will you be expecting from the fiscal authorities to help investors concentrate better without fear in the stock markets?
Okay, thank you very much for that question. Those things that we expect the authorities to do is for example, we want CBN to continue to be creating liquidity around FX market so that they can allow more participation of foreign investors in our market. When there is foreign exchange bottleneck, you will see that those foreign investors won't be able to come into and invest into Nigerian market. That is one. Two, we also want to encourage the federal government to continue to free up their market to allow free market for the demand and supply. Let them continue to stop all this subsidy for fuel, subsidy for electricity, so that the private business can thrive in our market. And if they thrive in our market, the federal government is expected to tell them to come and live in our market so that our market is more deepened than what we have today. So that we'll have a lot of investment instruments in the market that a lot of people can invest in. So we expect the federal government to continue in this manner which they are going. So those are the things that we expect the market to continue. The federal government to continue.
All right, Jamil Mohammed. All right, thank you so much. Thanks for your analysis. Appreciated right here on Channels Television Business Morning. Jami Mohammed is a stockbroker with APT Securities and Fund. This is back to you.
All right, Temple, of course, we'll be getting back to you in just a moment to review the debt and currencies market. And we'll also be crossing over to London in just a moment. Please stay with us. Welcome back. Breaking news this morning from the UK is that debt passed £2 trillion for the first time in history in July as the government spent billions on introducing measures designed to protect the economy against the fallout caused by the coronavirus crisis. But let's get more details of this data from Juliana Olayinka, who joins us from our London studio. Good morning, Juliana. So there we have it. Official data released this morning shows that the UK government borrowed £35.9 billion in August as tackling the economic fallout of the pandemic took its toll on the public finances. What more can you tell us about this data?
Well, no surprises here. We knew that debt is spiralling, as you said. £2 trillion is the current government debt, which is more than our economic output. This is the biggest amount of debt that we have seen on records, although records did begin in the 1990s. And of course, this is all due to COVID. The Bank of England have tried as much as they can to support the Treasury. Quantitative easing currently stands at about £745 billion. It's been significantly increased. Interest rates are at a record low of 0.1%, and they're likely to go into negative rates before the end of the year. Now, yesterday, Chancellor Rishi Sunak did unveil more economic stimulus that he'll be putting into the economy. Most notably is that job support scheme, which some estimates say it's going to cost the government here about £5 billion. But, you know, it has to be paid. It has to be sorted out. The government said that they are going to put their hand around each shoulder of every individual here in the country. And if you're told not to work, then there has to be some sort of buyback of that. And debt is the consequence and the answer. But we're suspecting that over the next couple of years, austerity is going to hit hard in the UK, and the government debt will be paid back by the taxpayer, us.
But at the same time, Juliana, Chancellor Rishi Sunak is warning that the COVID jobs plan will not stem UK's rising unemployment. And he says that Britain faces winter of business failures and job losses due to the COVID-19 impact. Tell us what are the key details about Sunak's winter economy plan.
Well, yes, you know, when the Chancellor was speaking at the House of Commons yesterday, he was pretty honest in saying he cannot save every job. He cannot save every business. No Chancellor can. And as we've seen from what COVID is doing, wreaking havoc across the world, it's not just here in Britain. Jobs and businesses are being laid off across the world. But of course, most notably is the job support scheme, which was unveiled yesterday in the winter economic plan. That will replace the much celebrated furlough scheme where the government were paying 80% and then 70% of people's wages. That ends on the 31st of October. And from the 1st of November, the government will be paying a third of an employee's wages. So if a business is fortunate enough to bring their employers back, they will be working on a reduced hours. So you'll be paid a third of what you're working. You'll be topped up by another third of your employer, and then you'll get an extra third from the government. It isn't very clear yet. This white paper is still being formalised. Of course, all of this is still very much breaking news here out of the UK. And the Chancellor did say that he will give further details closer to the time. In the hospitality and tourism sector, VAT rates will still remain reduced. I believe they're about 5% now. So at the moment, it's much cheaper to have a coffee or have a croissant in the morning because of that reduced rate. And then for business loans, there are several loans covering from small to medium-sized enterprises to big corporate organisation giants. Those loans that they received will last now, not just from 5 years, but to 10 years. And there are various other stimulus packages that were doled out yesterday, but I would say those are the headlines from that.
But while we wait for further details now, here's another warning coming from the British Retail Consortium, and it says that shoppers will feel the impact of a no-deal Brexit at supermarket tills. But apart from this warning, what's the latest regarding the Brexit deal?
Well, the latest is it's stalled. We don't really know what's going on. There's been so much domestic policy here in Britain at the moment. I suppose they're doing one thing at a time, but we know that a 9th round of negotiations kicked off with Brussels this week. I believe that Michel Barnier, the chief Brexit negotiator, may be in London speaking with Lord David Frost, his counterpart. A couple of weeks ago, Prime Minister Boris Johnson put a deadline of October the 15th to strike a Brexit deal, October the 15th, because that's when the EU 27 have one of their major events. And Britain are hoping that before that event, so that a deal can be ratified before the transition period ends at the end of this year, that a deal could be made. It doesn't look likely, but there is still optimism. There is still hope coming from both sides. I suppose one of the biggest spanners in the works is this internal market bill, which is a new piece of legislation overriding the Northern Ireland Protocol that has got the entire world up in arms about it. It was supposed to be going through Parliament, but I believe some appeasement has been made between Tory backbenchers, former prime ministers, and peers sitting in the House of Lords, just so that the EU don't scupper any of the negotiations with Britain. Earlier this week, Michael Gove, the Duchy of Lancaster, who is looking after a no-deal Brexit, did say that there are major concerns about what will happen in Dover and in Calais if a deal cannot be resolved. So there are so many issues taking place at the moment. And going back to what you were saying at the top, there have been concerns that if a no-deal Brexit is what happens at the end of the year, then the prices in the supermarket will increase by about £3.1 billion. A pack of Irish beef, currently costing about £3, is likely to cost about £4.10 if a deal cannot be secured.
And that's certainly not what anyone wants at this time. Well, thank you, Juliana. We'll see you again in the afternoon.
Thank you.
And it's back to Temple for a review of the debt and currencies market. Over to you.
Okay, so quickly, of course, NSDOTC got a bit of a decline yesterday. We got some interest in volume, and of course, if you look at that, 1.03. Food Concept, which opened at 68 kobo, was down to 74 kobo eventually. FGN bonds, we saw folks that came yesterday, was Thursday, the day after Wednesday, when the federal government had, where the DMO carried out the bond auction, and of course, that's secondary markets yesterday offered some investors the opportunity of checking out the auction bonds, the 2026, the 2035, and of course the 2045. But rates are really low now. We have Bankole Odusonya, the head of fixed income with UBA, joining us on phone. Bankole, thanks for your attention on the program. Rates, how far low do you think that we'll have this yields? This yield that is really nosediving at this point, how low do you think it will go?
Honestly, thank you. If you see where the Nigerian Treasury bills and the OMO bills are trading in the secondary market, the 1 year are now below 3%. In the last 1 month, they are hovered around 3%, but as we speak, they are around 2%. We expect FGN bonds to follow suit. From 2021 to 2025, bonds are trading as low as 3 to 4% yield. The 2026, which stopped at 6% at the last auction, is headed towards 5% right now. This is simply because of the limited amount of instruments issued by the DMO and the CBN in itself. What is happening is that a lot of funds are coming in from OMO maturities on a weekly basis. Most of these funds cannot go back into OMO, given the restriction of local corporates in bidding for OMO bills. This restriction had been put in place since September 23rd last year, so it's been a year old. So as funds mature, they are chasing other asset classes. Right now, we are seeing a lot of diversion and diversification of funds to equities markets. There's been sustained gains in the pricing and the increased index on the Nigerian NSE, simply as a result of what we're talking about. Limited instruments, debt instruments in the market currently.
Right, Bankole Dusonya, head of fixed income with United Bank for Africa. Thank you for your analysis. We do know that these will actually help the federal government to save more when it comes to saving its cost of funding all of these debts. It's something that was projected in 2019 at 211 trillion or 2.11 trillion naira actually before, but now in the revised budget it's 2.68 trillion naira. And with that, it looks like with what we're seeing, nosedive in rates at this point, and of course lower yields, is something that will help the federal government to actually save more way from that 2.68 trillion naira. I appreciate your insight on the program. It's back to you now, Bisi.
Thank you, Temple. And that's where we end today's program. Thank you for watching. I am Bisi Adebayo.